Welcome to the Monday 11th of January Smart Financial Planning Review of the Weekend Papers. A happy new year to you all. I hope you've had a fantastic holiday period and I wish you all the best for the next year. And fingers crossed at some point the snow will go away in order that being able to get to work and doing the day-to-day tasks might be a little bit more straightforward. As most of you know, it's not a huge issue for us because we only live a mile from home, but for most people things are a little bit more difficult than that. I thought for our first video blog of 2010 I would do a bit of looking back into history and just to see if there were some examples in history of companies and stock market behaviour that supports our general belief system. And our belief system is that you should diversify your assets and your investments as widely as practically possible, and that it's impossible to pick which company is going to perform better than another company based on their current stock market price and to their future stock market price. And intuitively that's always something a bit difficult to swallow. You naturally look at a company that seems to be growing and successful and assume that it's going to continue to grow and successful and that will be reflected in the share price. And you look at a company that seems to be struggling and you think, well, surely their share price must fall. But unfortunately it just doesn't work like that. And the reason for it is very simple. As you look at that company and think this is a good company going in the right direction, so is everybody else. So are the investment analysts, so are the brokers, and so is everybody else that's looking to buy in that stock. So therefore the price that it's traded at the moment already builds in that good feeling and expectation for the future. And similarly for a company that looks like it's going in the wrong direction, all that negativity is already built into their share price, and therefore it would be unreasonable to expect that it's going to fall further simply based on the information we have to hand. The absolutely key point that is going to change the price of both of those companies in that scenario in the future is what we don't know. And if you know that information and you trade upon it, that's called insider dealing. So for the majority of us who are seeking to make normal long-term investments, the best guide that we have to the value of a company, and I appreciate completely it's an imperfect guide, but the best guide that we have is the current share price. And here's a couple of examples of clever clogs seeking to look at the position a company's in, make projections with regard to its future and how catastrophically wrong they can get those. In 1999, WorldCom was viewed as being the must-own stock in the US stock market. It was an enormous company, turned over a phenomenal amount of money, had double-digit sales growth. So in 1999, one of the 12 best investments for 1999 in the Money magazine was recommended to be WorldCom. Roll forward only to 2002 and WorldCom was the largest bankruptcy of a company in the US in its history. So it looked like a great company, it traded like a great company, and 3 years later it was gone. Much more interestingly, because almost all of us will have some of their products, is Apple. Apple was forever seen as the company that won't work. And here's a few examples. A portfolio manager from a company called Transamerica had suggested that, this is in 2004, that Apple would need to sell nearly $1 billion of iPods this year in order to cover the costs of the new products. Behind the scenes there's problems. Apple had sold 3 million computers in the last year. Apple will remain a company that's neat from a product and consumer point of view, but crap from an investment standpoint. And obviously that's a direct quotation. Another clever cox called David Goldstein, the president of Channel Marketing Corporation, said that in his view, Apple had taken on 110 new stores. It would need to sell £12 million a year, $12 million I should say a year, in each of those stores in order to make them profit. And frankly, he thought their business was going to go bust. And what was the actual outcome? The share price for Apple in 2004, in April, was $23. The share price on the 18th of September 2009, adjusted for inflation, $390.86. So all of the clever clogs, all of the people who looked at what they perceived to be a poor and failing business, recommended going nowhere near it. It's ended up growing in stock market value from £23 to £390. And it comes back to the point that I made earlier on. The news that these guys didn't have was the news in the future about what was going to happen in that business, how it was going to be changed, and how it was going to be successful. So they made their plump, said it was going to be a dog, could not have been more wrong. I could give you 100 examples of this sort. I don't propose to do that. All it does is just reiterate the point. And the banking sector in the UK has been a brilliant example of that. If you look over the last couple of years at whether you would think investing in banks was a good idea or investing in banks was a bad idea, you just wouldn't ever be able to know. There are plenty of people who decided that Northern Rock had got to a point that it couldn't fall any further and piled in, and then what happened? The shares became absolutely valueless. So I repeat the point that I started with. Smart Financial Planning believes absolutely that you should diversify the investments that you make as widely as practically possible, and believes that the value that the stock market attributes to a company at present, although likely to be wrong, is the best indicator of its actual value, and therefore it is not reasonable to assume that the price will go up and down because you think that price is inaccurate. It's a bit heavy for this week. I'll try and come up with something a bit lighter for you next week. All the best.